The top one was 743%. So I thought, well, maybe people would be interested to know what was the secret sauce that caused those stocks to do so spectacularly.
He shares his 2024 picks on Consuelo Mack Wealth Track. Look for it on your local public television station and on wealthtrack.com.
Funding provided by Clearbridge Investments, First Eagle Investments, Royce Investment Partners, Baird, Bill Miller, Research Affiliates, Strategas Asset Management, Women Investing in Security and Education, and Matthews Asia.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Stock picking is not easy. As we have reported numerous times on Wealth Track, it's become more difficult over the years because there is so much more competition. Hundreds of millions of dollars are devoted annually to quantitative and fundamental research by humans and computers. With few exceptions, active stock managers have underperformed passive index funds for years. According to Morningstar, only 16% of U.S. large value funds and 5% of large growth funds beat their passive index fund equivalents over the past 2 decades. The figures were 12 and 10% respectively for 10 years. The last 5 saw some improvement, but still less than a third of these actively managed equity funds outperformed their passive equivalents. So imagine my surprise when I received a book about identifying top-performing stocks written by an award-winning bond analyst whom I have known and respected for years. The book is The Little Book of Picking Top Stocks, How to Spot Hidden Gems. The author is Martin Fridson. Fridson is the Chief Investment Officer of Lehman Livy & Fridson Advisors, an investment management firm specializing in income investing that he co-founded in 2013. He is the publisher of the Forbes Fridson Income Securities Investor newsletter. He is the author of several books, including Financial Statement Analysis, A Practitioner's Guide. Now, Fridson made his reputation in the bond world. He's been called the dean of the high-yield bond market. In 2000, he was then the youngest person ever inducted into the Fixed Income Analyst Society Hall of Fame. So why did he decide to write a book focusing on short-term stock picking?
There are books about picking good stocks, but the best stock to find as the number one total return stock for the year in the S&P 500 was someone no one had really focused on. And to tell you the truth, this year has been an exception because people are very familiar with NVIDIA. But in past years, if you asked someone, they wouldn't even know what it was. I haven't found anyone that I asked who knew that in October 2022, Occidental Petroleum was the number one S&P stock for the year. It gets reported, but doesn't get a lot of focus. And these stocks historically had returned typically about 150% for the year.
Wow.
The top one was 743%. So I thought, well, maybe people would be interested to know what was the secret sauce that caused those stocks to do so spectacularly.
Marty, you've basically identified 4 basic criteria that seem to determine what stocks are going to be top performers in the year ahead. So let's go over them one by one. They're actually quite surprising to me. I mean, the first one is high volatility, that a stock's got to have high volatility. Why does that matter?
Well, by definition, a stock that goes up about as much or as little as the index in a given year isn't likely to be one that'll break out and do much, much better than the index in a given year. So you really need to look at stocks that have that characteristic of some big ups and big downs, and realize that this could be a year where it'll turn out to be one of the big downs rather than one of the big ups.
Credit rating. I mean, you know, you are known as a superb fixed income analyst, but the credit rating is in the speculative range or just slightly the lowest investment grade. Why do these companies tend to have a more speculative credit rating?
The answer to that is, if you think about why do companies have a lower credit rating, one is that their earnings and cash flows are very erratic. And so that gets back to the volatility, because if they have big swings in their earnings, then their stock prices are likely to have big swings as well. The other reason that they'll have a low credit rating is a lot of debt on the balance sheet, otherwise known as financial leverage. And what that term refers to is that it acts as a lever for the earnings of the company from year to year. So again, comes back to that volatility and the potential for that real liftoff that can propel it right to the top.
Comparatively low market cap among S&P 500 stocks.
Yeah, I think the bigger market cap stocks are already very widely owned among institutional investors, and chances are the institutional investors that do own them are pretty close to the limit of how much of it they can own. Whereas if you get into the lower reaches within the S&P 500, you've got some potential new players and room for the existing players to add more to what they own. So that can be the fuel that will help drive that stock higher.
A wide dispersion among analysts' earnings estimates for the stocks.
We found that the earnings estimates themselves were not helpful for this specific purpose of identifying a stock that could be number one. But the dispersion was useful, and I think the reason behind it is this. If their company meets the earnings estimates, but they're all bunched closely together, that's not a surprise to anybody. No reason for the stock to jump on that news. But if it reaches the top earnings estimates and the bottom ones are much below that, that is a surprise to the investors who were following those analysts who were more pessimistic. So it simply has that greater potential for a big jump.
So it sounds like the stocks that perform well in any given year that you've identified, there's a tremendous amount of uncertainty around them. And so they could surprise to the upside, which I guess they do. But do they have an equal potential of surprising to the downside? I mean, have you noticed, what are the worst performing stocks? Do they have any of the similar characteristics to the top performing ones in any given year?
This is why I don't recommend putting a large part of your portfolio into this. It's something that I think can be instructive in terms of how stocks perform, and it can be kind of fun and also an outlet for that speculative urge that many of us have who are very interested and passionate about the stock market. But absolutely, there are some other qualitative characteristics, such as some of the big winners have been companies that had a major, really dominant competitor, the proverbial 800-pound gorilla. And if that company faltered for some reason, getting production of semiconductor chips out in that year, that opened up an opportunity for that second-tier company to suddenly surge ahead, have an unexpectedly big revenue gain. But that might not happen, and it might, for other reasons, perform poorly that year.
You mentioned that NVIDIA was not one of the stocks that you picked for 2023, that it only met one of the criteria that you've just outlined. So what happened to NVIDIA?
Well, it did meet the criterion of being volatile.
Yep.
Continues to be the case. However, it's no longer in the bottom half by market cap as it was in 2016, when it was also the number one stock in the S&P 500. So their success has made them less likely, but in 2023, we had an extremely unusual year. As been well publicized, the S&P was highly concentrated in the so-called Magnificent Seven. Technology was very hot, with very ordinary returns in many of the other stocks in the index. And artificial intelligence was the key. I don't want to draw too close an analogy with the dot-com boom in the late 90s, but that was a similar period where you saw one particular factor, a technological innovation that everyone was very excited about, that kind of swept away all the ordinary characteristics of how the stocks in the market performed.
So Marty, what stocks have you identified as the potential top performers of 2024?
Well, of course, it'll depend on not having the same kind of a year we had in 2023, with so much emphasis on artificial intelligence, concentrated in a particular group of stocks. I want to emphasize these are not recommendations of Lehman, Livy, and Fritz and Advisors. But statistically, these are the 4 stocks that checked all the boxes that we spoke about a few minutes ago. And those are Boston Properties, an office REIT, Carnival Corp, and Norwegian Cruise Lines, which are, of course, in the cruise industry, and also Expedia, also closely tied to the travel business.
What do you do with this information, Marty?
I've tried to encourage people to get onto this and say, well, this would be something that would be challenging, an outlet for those speculative urges that if left unchecked could cause some real damage. So if you take just a very small part of your portfolio and say, well, maybe with other members of an investment club that I'm in, we compete for this, maybe put $20 into a pool and have take the winner out to a nice steak dinner or something like that. But along the way, get some new insights into what really drives the stocks and how some of these criteria, as you say, it's not price targets of the analysts, it's not insider buying, it's not short interest. A lot of the things you hear about, maybe those things matter, but some of these other less heralded factors could be things to look at in all of my work in trying to select stocks for my portfolio.
And it's so interesting. So this has nothing to do with fundamental analysis. These are just statistical. They fit the boxes that have succeeded in the top performing stocks of the 10-year period from 2012 to 2022, right?
That's right.
And what's also interesting is the outperformance, again, going back with these criteria it's for 1 year only. So you just decided, just take a calendar year and analyze the performance and see what you come up with.
Yeah, because I thought that would be a natural thing for people who want to do this, maybe as a competition with friends and so on. The annual cycle would be a natural fit and build up suspense through the year and see how it all comes out.
And do you have any idea how these stocks then perform the following year, or do they stay in the top performance or near top performing, sectors, or do they just drop out, or did you do any follow up on how they perform after that 1 year?
Well, we had one in recent history that was back to back. Advanced Micro was the #1 stock in the S&P 500 in 2 successive years. So as you can imagine, it isn't dependent on having a terrible year and then rebounding from it, because that was a counterexample. And Netflix was not back to back, but was on the list twice in a 10-year period. So it's quite possible that you'll have a repeater again in the future.
Put on your bond analyst hat for a moment, and what's your assessment of opportunities in the fixed income markets?
I've spent a lot of my career focused on the high yield bond market. Unfortunately, you're not getting paid especially well for the credit risk right now. The investors, after a long period where they couldn't justify owning bonds, with no yield, no upside in them, this gave rise to this phrase, there is no alternative, or TINA. Now that that's come back and they say, yeah, we can justify having bonds and it's good to have them for the balance in the portfolio. Investors are focused on the much higher yields than they've seen in a long time, and not as much on the risk premiums, particularly when you get into the corporate area outside of the, we hope, default risk-free treasury market. We believe that we'll see further declines in interest rates, maybe not as fast or as aggressively as the futures market is expecting in connection with the Federal Reserve's expected rate cuts. But we do expect rates to be lower, so there is some capital gain potential. And of course, the further out you go in the maturity spectrum, the greater that potential is, and the greater the risk. But if we're right that rates will come down, you get paid better the longer you're willing to go out.
So why do you expect rates are going to come down? And you said not necessarily this year, but eventually.
Well, the Fed was extremely aggressive in pushing rates up, and they we're rightly concerned about the specter of inflation. That has come down. So I think that they will eventually want to bring rates down because, along with that, people have said, oh, well, that recession didn't happen. Don't be too early on that because we have an inverted yield curve. The short-term rates higher than the long-term rates, which is the unusual characteristic.
Right, and that's been for like months, right?
All recessions have been preceded by an inverted yield curve, and when an inverted yield curve did not precede a recession, it was a very short and only slightly inverted curve. It would be extremely unusual for this not to be followed by a recession. And the point that people aren't emphasizing enough is that recessions have begun after the curve has ceased to be inverted. And it is still inverted now, so you can't write off that possibility.
Right. A number of bond managers I know have been advocating locking in higher rates, extending their maturities. Are you in that camp by any chance?
Yes, we are,
Okay.
because the yield curve will eventually go back to positive with the lower rates being, or the shorter maturities being at lower yields than the longer dated maturities. So you're going to see a bigger drop in the short end than in what is referred to as the belly of the curve 3 to 5 years out. So it would make sense, even if it's sacrificing a little bit of yield right now, to lock in the rates and not be stuck in the short end where rates are likely to fall very precipitously.
And you mentioned the high yield market as well. How do they look as far as a value proposition and the kind of income that you can get from a high yield bond versus an investment grade bond, for instance?
If you compare it to the Treasury market in particular, you're not getting paid nearly well enough.
Okay.
That's based on credit availability, some economic indicators, the current default rate, and whether or not the Fed is engaged in quantitative easing, which is very definitely not at present. So there is vulnerability there of that risk premium increasing as the supply increases. I think a lot of the explanation for that narrow risk premium is just that the supply with low volume of issuance in the high yield bond market in the last couple of years has created a shortage of supply to fill the demand from investors who are on mutual funds, institutions who have an allocation to high yield.
And are you seeing higher default rates by any chance? I mean, I'm just thinking, we've had a big increase in interest rates, so financing costs have gone up, and companies with lower credit ratings tend to need outside financing frequently. So is that a factor at all of the high yield market?
Hasn't really shown up in the default statistics yet, and the percentage of issues in the high yield index that are trading at distressed levels, which would indicate high risk of default, is way down from a year ago. So keep in mind that companies don't refinance all of their debt at the higher rates immediately. They have maturities stretched out, and they can, if they manage things well, gradually reduce debt if need be to lower their overall interest costs. The other thing that's happened is the companies that were facing potential distress have been able to get new loans from the private credit lenders. This is a category that's just grown tremendously in the last few years, and they'll specifically come in and say, your existing bank lenders are looking to tighten the screws. We can offer you a better deal, and we can find a loophole that enables us to do that without the bank lenders being able to block it. And that's been a very big factor, averting what might have been greater distress as a result of that rise in interest rates that you spoke about.
Right. So, Marty, are you concerned about the fact that there has been a tremendous amount of private credit borrowing? And I know a lot of institutions are recommending it. But again, these are companies that aren't able to get financing through traditional means, or it's very expensive for them to. So should we be looking at private credit as an asset class?
Well, it's, as you say, become very popular.
Yeah.
I think everyone out there on the institutional side is looking at it. The yields look attractive. Just in the last week, there have been some stories about discrepancies in the mark-to-market among different funds. You know, look at the same loan, one is carrying on its books at a given price, another at a lower price, and even examples of within the same company running two different funds and marking at different prices. So that's a little bit of a concern. And there has been also a report recently that many of the major institutional investors are reducing their exposure. So those looking to come in now may be a step behind, and I'd be a little bit cautious. It came up just recently on the investment committee of a nonprofit board that I'm involved in. We decided not to get exposure through the business development companies, which are one of the groups of providers where you can buy the stocks of those companies. But we decided against it, and it was right after that some of that press appeared. So I think we probably felt good about that decision. Not that we might not revisit it in the future, but for now we were reluctant to create an allocation for that asset class.
Marty, what would you recommend for one investment for a long-term diversified portfolio that we should all own some of in a long-term diversified portfolio?
Yes, for long-term, particularly if you're focused on income, we're very enthusiastic about the crossover preferred stocks. So those would be stocks with credit ratings kind of at the boundary line of investment grade and speculative grade or high yield, namely triple B or double B. And to give you an idea, if you look at the corporate bond market, triple Bs, the index run by ICE Indices, is currently at about 5 5/8%. Their double B index about 6.5%. If you look within the double B preferreds, they are double B plus, double B minus, but right in the middle range, the median yield on those securities is about 7.25%. And that understates the difference because many of these preferreds, unlike most corporate bonds, have paid qualified dividends, which means that they're taxed at the capital gains rate of 15 or 20%, depending on your tax bracket, as opposed to the ordinary income rate, which can run as high as 37%. And while I'm talking about preferreds rated in the speculative grade category, they are, for the most part, preferred stocks of companies that have investment grade ratings on their corporate bonds, but because they're lower in the capital structure, they're rated lower. In that middle double B category that I spoke of a moment ago, I recently found that 83% of the issues were preferreds of companies with investment grade ratings by one or more major rating agency.
These preferred crossovers are the one investment, but is there like kind of an overall income strategy that you're recommending, or is it too difficult to generalize because you're dealing with separately managed accounts with individuals?
The key for us is that we have a diversified portfolio, not only by issue but by asset category, because if you look at these categories, which include such things as preferred stocks, dividend growth stocks, which are there to generate higher income to offset the decline in purchasing power of the income you're getting, and bonds, primarily higher quality, but we have an allocation towards lower quality bonds at this point, because these different asset categories perform differently in different economic conditions, different financial market conditions. So you want to steady out that performance by having exposure and allocations to all of these different types of income investments.
Marty Fritson, thank you so much for joining us on Wealth Track and covering both picking short-term top performing stocks and talking about the fixed income strategies as well. We really appreciate it.
Yeah, it's really been a pleasure to be here. Always great to see you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is read Marty Fritzen's book, The Little Book of Picking Top Stocks, How to Spot Hidden Gems. Fritzen is the first to point out this book is for individuals who enjoy active investing, want to learn more about analyzing stocks, and recognize this approach is for short-term gains and a small part of a portfolio. For those of you who want to swing for some financial fences, The Little Book of Picking Top Stocks is fun, well-written, provides some really interesting case studies of past winners, and will sharpen your analytical skills. Next week, Sarah Ketterer goes where others fear to tread in her incessant quest for value, where and what she is buying for her gold-rated Causeway funds. In this week's extra feature, Marty Fritzen reveals his passion for music and how it has helped his career on Wall Street. Please follow us on Facebook, X, and our YouTube channel. Thank you for watching. Have a lovely weekend and make the week ahead a healthy, profitable, and productive one.